Before we get going, I just want to say thank you to everyone that's already here for this fireside chat with Matt Bloomfield, President of Palmer Square Capital BDC, who will be in conversation with Matt Ferguson, CEO and CIO of Pandi LLC. Matt and Matt will discuss their respective backgrounds shortly, but before we begin, I'd like to reiterate that the forward-looking statements provided during this call are based on current expectations. The statements that are not purely historical are forward-looking statements. These forward-looking statements are not a guarantee of future performance and are subject to uncertainties and other factors that could cause actual results to differ materially from those expressed in the forward-looking statements, including without limitation, market conditions caused by uncertainties surrounding interest rates, changing economic conditions, and other factors Palmer Square BDC has identified in its filings with the SEC. Although the company believes the assumptions on which these forward-looking statements are based are reasonable, any of those assumptions can prove to be inaccurate, and as a result, forward-looking statements based on those assumptions can be incorrect. You should not place undue reliance on these forward-looking statements. The forward-looking statements made during this call are made as date hereof, and Palmer Square Capital BDC assumes no obligation to update the forward-looking statements unless required by law. To obtain copies of SEC-related filings, please visit the company's website at palmersquarebdc.com. And with that, I will get out of the way and turn this call over to Matt and Matt. Welcome, guys.
Thank you. Hi, all. I'm Matt Ferguson. I'm the CEO and Chief Investment Officer at Pandi LLC. Pandi is a SEC registered investment advisor in Kansas City. We provide investment advisory services and family office services to institutional scale portfolios across all asset classes, public, private, with a focus on credit and equity. I've been working in capital markets for more than 20 years. I'm a CFA charter holder and received my MBA from the University of Chicago. We've been a partner of Palmer Squares for many years, and I'm excited to be here today with Mr. Bloomfield. So to get started, Matt, why don't you provide a little background on yourself, your role, and the broader Palmer Square platform?
Sure. Thanks, Matt. And thank you, everyone, for being on today. In addition to serving as president of Palmer Square Capital BDC, I'm a partner and portfolio manager at Palmer Square. I've been with the firm for going on 12 years now. And prior to that, spent a decade plus in Chicago, predominantly at Golub Capital, so another large kind of private capital alternative asset manager. Palmer Square as a whole, we manage a little north of $36 billion in capital, all in kind of alternative credit related strategies, public and private credit, structured credit. And so, we have, as part of our opportunistic and private credit platform, our Palmer Square Capital BDC, which, we're predominantly here to talk about today. Palmer Square was founded in 2009, so we've been around for over 15 years. And really, these strategies that we've talked about or that I alluded to, is what we've been doing as a firm since our inception. The senior investment team here that I work closely with, we all average over 20 years of credit experience. So we're very, very familiar, with all these asset classes and markets in which we've been investing for quite some time as a large team.
Yeah, great. So Matt, as you think about the Palmer Square platform, what advantages of that platform caused you to start the BDC, and how do you think that provides an advantage to you as you operate the BDC today?
Yeah, so we started kind of launching our version of the BDC in 2019. It's a product we've been very familiar with from some of our past firms that manage BDCs. We really like the structure, really like the flexibility that it affords from a portfolio management standpoint, and what we can do to achieve what we view as good risk-adjusted returns for investors. But given our setup here at Palmer Square and how we invest in corporate credit, how we want to manage risk, we went about setting up our BDC in a bit different manner than just your traditional direct lending, private credit, middle market lending BDC, which obviously is the vast majority of the public and private BDC space. A lot of our background has been in kind of larger capital structures. We do tend to prefer larger businesses as a whole, or lending to larger companies. We think they tend to attract better management teams, have better risk management, and quite frankly have better access to capital markets over the long term. And so we set it up with a more liquid focus. So we're not just another direct private credit lender. Our BDC is comprised of a lot of larger, more liquid, broadly syndicated loans. We do have a healthy allocation to private credit, but again, those are the larger borrowers in the market. We're not doing kind of traditional middle market or even lower middle market lending, with continuing to focus on what we think are kind of the larger, better run private equity backed companies out there. So as we put that together, structurally, we wanted it to look different than other BDCs as well. We'll probably talk about this in later questions, but kind of set up, the fee structure, the financing structures, a lot of the kind of nuts and bolts of the BDC in a more investor-friendly manner, which has less fee drag and allows us to, kind of invest in those larger, more liquid companies, but still achieve what we think are good risk-adjusted returns and yields, comparable to other BDCs in this space.
So Matt, when we think about and we look at the BDC space specifically, you do stand out in the fact that a significant majority of your portfolio is liquid. Do you have the flexibility to do loans in the private space, and how do you think about the relative value of shifting in or out of the liquid credit market versus the private credit market over time?
It's a good question. We do have the flexibility. That's one of the kind of key components of when we started out, having that liquid portfolio. It does allow us to utilize what is now a 1.5 trillion secondary loan market. We can, trade in and out of those companies. We can raise capital to deploy into other asset classes, as you mentioned, private credit, which has grown, very significantly over the past decade. And what we've seen as these private equity ecosystem has evolved, you see a lot of these larger companies kind of going back and forth between private credit, broadly syndicated credit. Part of that depends on, where spreads are at any given point in time, but also, what the, goals of those individual companies at those private equity firms are looking to achieve. And so there's certainly advantageous scenarios where you want to finance in the broadly syndicated market. But there's also opportunities, whether it's M&A related, additional financing flexibility related, where the private credit ecosystem can be more accretive, even though your spreads tend to be higher there. So we like the BDC structure. It gives us that flexibility. The way we've managed the portfolio to be overweight, on the more liquid side of things, gives us the flexibility. Even in a market where, over the past several years, M&A has been very, very slow. We're not relying upon originating into the private credit ecosystem just to manage the portfolio or kind of maintain a portfolio. We can buy loans in the secondary market. We can participate in the new issue broadly syndicated market as well. So we really like that flexibility. We have over time, taken the private credit allocation in our BDC up to around 10%. And we certainly have the flexibility to increase that or decrease that, to your point, based on what we're seeing from a relative value standpoint. I think you hear on a lot of BDC earnings over the past years, spreads have certainly continued to tighten across most credit asset classes, regardless of where you look. So I do think it is important to have that flexibility to be able to toggle across multiple markets to maintain an invested portfolio, but also to move to where you're seeing the best relative value and the most interesting things from a portfolio composition standpoint.
Yeah. So when you think about the BDC space, Matt, do you see any other BDCs that have the same structure you do that goes back and forth as readily as you guys have the capability to do, or how do you see it?
No, we don't. I mean, we think we're pretty much the only, public BDC with this type of strategy. That was purposeful when we launched it. We kind of drew down the initial first part of capital and in early 2020, right before COVID hit. So maybe not the best timing, but no, I mean, we've been purposeful in how we've structured it, and we really haven't seen, there's been a handful of IPOs in the past few years in the BDC space, but they've all tended to be, kind of the similar, private credit, direct lending type structures. So we feel like we're the only ones in the market that have this approach to it and this differentiated approach, which again we think really fits our core competencies as a credit manager, and we do think offers an interesting diversification for BDC investors that aren't looking for just another private credit allocation.
So it seems that you guys set this up to you know be invested over a long cycle. So as we sit here today and you think about relative value in the broadly syndicated market, the private credit market, where are we in the credit cycle? Where are we in the liquid versus private credit cycle? How do you think about allocating capital in the coming years and maybe more specifically 2026?
Yeah, it's been an interesting, really last 5, 6 years when you think about, all the evolutions of risk asset classes and where we'd be at in a credit cycle. Obviously, COVID was more of a short-term liquidity, volatility induced period of time versus a real credit cycle. The back half of 2022, I think, when you look back, you did see, some real volatility, some real, strains in the credit market. A lot of that, though, right, was when you think about how rapidly rates, risk-free rates were rising, that induced a lot of volatility. We had some, geopolitical things popping up that seemed to be a regular occurrence at this stage. We had, the regional banking, crisis, if you will, in the spring of 2023. So there's been some mini episodes, but we haven't had a true, credit cycle in a long, long time. Even looking back to GFC, right? That was more of a liquidity crisis. So it definitely feels like, we're advanced. I don't have a specific inning I would put it on in baseball terminology, but what I think is interesting is that, when you look across our portfolio and when you look across, other credit portfolios, companies are still performing pretty well. We're still seeing EBITDA growth. We're still seeing top line growth. It might not be, high single, low double digits like we saw for a couple of years, but in credit, we don't necessarily need or want that, right? We just need slow, steady growth to feel, well covered from an LTV standpoint. I think what we've seen over the past couple of years is a dearth of M&A activity. It's been very, very slow. Whether that's private equity related or even on the public equity side of things. And I think people have been wanting to see that pick up for quite some time. Certainly, as rates have come down, that's helped. Private equity, firms are certainly under pressure from their LPs to return capital. And I know you see a lot of that in what you do as well. So it feels like we've been, gearing up for a pickup in M&A for quite some time. And I can finally say with some certainty, we are having a lot more conversations than we've had in a long time. With our sponsor relationships, both on the broadly syndicated and on the private credit side. You have seen some pretty big headline M&A announcements, certainly like the EA take private, which will be the largest LBO of all time. Whole Logic is a very large take private from Blackstone and TPG, and that's interesting because it's got a mix of broadly syndicated first lien and privately placed second lien. So it kind of marries both markets that you were just alluding to, which I think is great from a capital structure or capital markets standpoint. And for us, personally on our BDC, right, we get to look at both of those instruments and find out, what we think makes the best sense for our BDC. So I like where the trends are going. I think the one thing, we're hopeful on, and I think would, really kind of unlock the M&A capital markets would be the, kind of $1 to $5 billion size enterprise value businesses that are kind of sponsor to sponsor transactions. That's, what we have not seen much of over the past couple of years. And I think what a lot of, BDCs and other, liquid and private credit investors are really hoping to see is that, kind of, sponsor to sponsor type M&A activity pickup, which definitely feels like is starting to be the case finally.
Sure. I know a lot of LPs and private equity funds are looking for liquidity, so it seems that that is likely to happen at some point in time when the markets are stable for them to engage in transactions. On the outlook, um, rate cuts, or as JP Morgan introduced yesterday, maybe rate increases, um, and spreads. How do you think about rate cuts, or I guess rate increases? Spreads seem to be historically tight, um, which could be a helpful tailwind to you all. How do you think about the movement of those two variables as you think about performance of the BDC and how you might reposition the portfolio in the coming year?
Yeah, it's tough to be. I think if you look back over the past couple years, the forward curve has been incredibly wrong in predicting where base rates are going to go. I think from our vantage point, we have a lens into several hundred portfolio companies across the broader Palmer Square platform, in addition to just the BDC. And I think when you talk to a lot of management teams and CEOs and CFOs. From what they've been seeing, it definitely, I don't think anybody feels, all clear from an inflationary standpoint. You're still seeing a lot of wage pressure at businesses. Now, obviously, some of the hiring has slowed down, and you're seeing that in some of the employment data. But you haven't seen a lot of, significant wage relief. Now, it's not growing year over year as rapidly as it was from kind of 22, 23, and 24. But that's still, inflationary. And so I think, the Fed's cut 150 basis points over the last 14 or so months. I think with some of the data that's been challenging to really decipher, it feels like that is definitely hopefully going to slow down here a little bit as kind of reassess where things are at from an economic and eco data standpoint. But as we think about our portfolio, we kind of want to control the credit risk and not the rate risk. And so I think we feel good about the overall performance of companies in what has undoubtedly been a pretty challenging market when you think about higher base rates and the interest costs that these companies have had to service. When you think about some of the inflationary and wage labor pressures that companies have been under. So I think when you look back over the past several years, you have to feel pretty good about how levered credit has performed in general. Now, certainly, I think there's been some pretty good volatility in the overall BDC space. Over the past 6 to 9 months. It feels like a lot of that was kind of rate induced. I think as people understood that the base rates were going to come down, your yields are going to come down, right? And so I think it's always important to look at it not on an absolute basis, but on a relative basis. What are you earning relative to risk-free rates? And risk-free rates are going lower, but you're still, in the BDC space, and in our BDC, we view it as a very attractive yield, still in the double digits, right? From what you can get in other, credit asset classes, it's still incredibly attractive in our opinion. And even if base rates do, come down, I think there's still, 50 basis points of cuts priced into the curve in 2026. We'll see if the JP Morgan rate strategists are right
Yeah.
and we get a hike next year. But on a relative basis, it's still really, really good yields in our opinion, especially for the credit risk that you're taking.
So let's talk about the credit risk in the portfolio, Matt. As we look at the BDC space, I'm looking at my comp sheet here. Your non-accrual rate is, certainly top quartile, if not one of the highest, lowest in terms of, best, right? Your non-accrual rate is the lowest. You have 200 plus positions, highly diversified, not concentrated, larger EBITDA businesses that are presumably more established, better managed than perhaps the smaller counterparts in the private credit space. Our view is that your credit risk is perhaps maybe different or better than other BDCs. How do you think about credit risk? How do you think about managing that in the portfolio?
Yeah, I mean, we think about, day in, day out, risk management is kind of, at the top of our priority list, and how we think about portfolio composition and risk management, is very, very key. and very, very important. I think from our standpoint, diversification is always probably the biggest tool you have from a risk management standpoint. We obviously are credit pickers. We want to find the companies we like best and invest in those. But undoubtedly, when you're running a large portfolio, diversification is your friend. So our average position size is about 5 million. Across the portfolio. And so to your point, with over 200 positions, we do have a very diversified portfolio. We also think about industry diversification, right? Because as you look back over the past 20, 30 years in credit, when you do get into default cycles, a lot of times those tend to be industry related. And so you want to think about industry diversification as well. So that's paramount for us. I think when you look across, other BDCs and similar vehicles, a lot of times you'll see some pretty heavy concentration, in a handful of names. And as long as you're, correct in those, it can be okay. But if you have an issue with a very large position, that can certainly have an impact on a portfolio. So we think about diversification immensely, and think that's one of the key benefits of our portfolio, and why we've been able to have lower non-accrual rates than the industry. Diversification is one point of those. I also think we do have the ability to move the portfolio around. We don't. In the private credit situations, right? You're underwriting that credit for the long term. There's no liquidity. One on the broadly syndicated side, as I mentioned, there's a huge, $1.5 trillion secondary market, and so we can look at things on a relative value basis. We can sell positions if we become concerned about them. We don't have to be, wedded to those indefinitely. But we can also trade those on a relative value basis, because sometimes things are overvalued, right?
Sure.
Or you kind of want to move to another segment of the market or another industry that's offering better relative value at a given point in time. So those are things we think about from a risk management standpoint, and kind of what we're trying to achieve. And I think when I look back, not just on our BDC, but on our other credit strategies over the past 10, 15 years, I think that's led to really good outcomes, and why performance has been so good.
Got it. So as we look at it, Matt, we have the BDC, the PSBD, that's got presumably pretty good credit risk management. You rank, if not the highest, among the highest of all the BDCs, and you have the highest dividend yield, amongst the BDCs. So how do you think about that? Obviously, a driver of that is the NAV position. Talk to us about NAV. Talk to us about how you think that will move forward, and your perspective on the high yield relative to what is looking like a top quartile credit risk profile.
Yeah, and that's one thing we didn't talk about. So because of the underlying liquidity in our portfolio, and we're able to get effectively daily marks on those, we do post a monthly NAV for investors. It's real. It's based on real prices, and so investors can kind of see that on a monthly basis versus quarterly for all other BDCs. So I think in our mind, that it kind of eliminates a lot of the questions investors will have about, what is the true NAV of a portfolio at a given point in time. What discount should an investor be subscribing to the NAV because, spreads have widened, or there's been volatility, but, maybe the NAV's not necessarily moving. So we do think that's an important transparency tool for investors in our portfolio. You can see it on a much more real-time basis, and kind of believe in what that NAV is. I think certainly there's over the past several months across the BDC space, the industry's traded at a pretty big discount to NAV, and I think investors are probably questioning what those marks should be, given that everything that's transpired. So I think from our standpoint, you've seen some continued rate volatility, which does affect spreads. And we talk about spread tightening in general across most credit asset classes, but there's certainly parts of the market where whether it's AI risk associated with businesses, just some of the healthcare space that's had challenges over the past few years coming out of COVID. You've certainly seen wider spreads in certain markets there, and so I think it's really it can be challenging, I think, for BDC investors to really know kind of what that NAV can look like in a portfolio that has no liquidity. And so I think that's a key differentiator for us, and something we think should give investors comfort is kind of our NAV transparency and what they can kind of count on as being a real NAV. And I think as we move through this year, we'll see. I do think as M&A volumes pick up, it's going to give us the ability to hopefully find some great new credits at attractive relative value. And as we've had a lot of refinancing activity kind of taking place versus new issue activity, we've been able to to get some pretty good income generation from those refinancings, as those kind of get taken out at par, and we're able to book a little extra income just due to that refinancing activity. So that feels like that's going to continue to be accretive as we move through 2026 and capital markets continue to open up.
Yeah, that's great. I mean, we look at the monthly NAV, Matt. You've got publicly traded securities in the that are disclosed monthly, and to see the NAV discount, there's certainly a gap there, and that's something that we look at as an attractive feature of where the current price is. When you think about the alignment that you and the team have with regard to the long-term performance of the BDC, maybe just take a minute to talk about that structure, why you think the management team, specifically you and others, are well incented, and then also why it's aligned with the investor group.
Yeah, so when we set it up, I mentioned it was purposefully differentiated, and because of the type of loans we're going after, that larger, bigger companies, they actually tend to obviously have a bit lower spreads than their smaller counterparts, and so we still wanted to generate an attractive yield for BDC investors. So the easiest tool for us was to charge lower fees. So we're one of the very, very few that only charge management fees based on net assets, not gross assets. Our view there was, we shouldn't be incentive to utilize leverage from a management fee standpoint. We should use that where we view it, prudently and from a portfolio standpoint. And so, if we take leverage up or down, that doesn't change what management fees are. It's a net fee or a fee on net assets. So on an equivalent basis, if you converted that into more of a gross figure, it'd be about 0.7% versus 1 to 1.25% for most of others. We also just charge a flat lower incentive fee, and have a 3-year plus look back on realized losses. So we thought, if we're not doing well from a credit standpoint, we shouldn't be compensated for that. So the biggest aspect of
Seems like you're doing well from a credit perspective, though, broadly.
Yeah, I mean, we definitely feel good about that. But yeah, I mean, we just wanted to have a lower fee structure. We thought that was the right thing. It'd be less fee drag to the end investor. So that was part one. Part two, on the financing side, because we're financing a lot of these larger, more liquid, broadly syndicated loans. We have a much cheaper access to capital from a financing standpoint, which again is a lower drag. And we've kind of been actively refinancing our financing facilities on the broadly syndicated side. We do have a nice private credit facility that we utilize as well, where we just refinanced that, and we announced that last quarter, but we shaved 55 basis points over off the spread of that. So that's attractive. We have issued a CLO out of our BDC, which we did in the spring of 2024. As we've talked about spread tightening, the CLO asset class as well has had a lot of spread tightening over the past 2 years. So that will be refinanceable here in a few months as well. So we have a lot of tools that we work on the balance sheet side of the equation to help keep fees lower and keep fee drag lower for our end investors as well. And then, we've also, instituted share buyback programs from both the BDC itself and from the management team standpoint, where that has been, active in the secondary market, where we think, as BDCs have been, or and our BDC had been trading, at a pretty healthy discount to NAV. We felt it was very accretive, to the structure to be buying those back
Sure.
at those levels. So that program's been running as well. So we tried to put in as many tools in the toolkit, if you will, from a structural standpoint to align ourselves with the investors and make it as investor friendly as we could.
Sure. So one final question. We get to the questions, Matt. Why do you think now is an attractive entry point for shareholders, and maybe any final thoughts on takeaways from today's discussion?
Yeah, I think there's a lot of reasons I think why, especially at these levels, why the BDC is attractive at this stage. Certainly, I think a lot of rate declines have been priced into the market. We've experienced quite a few of those, and there's potentially more to come. But I think still on an absolute or on a relative basis, these yields are still incredibly attractive. It's when we looked back when we were setting up the BDC, it was, kind of over a long period of time, it was kind of a, called an 8% type yield market, which was always viewed as pretty good at the time. And I think, over the past several years when we've been, in these kind of double digit yields on the credit side of things, it's on an absolute basis has certainly been, super attractive. And I think, people kind of got used to that, if you will. But even as spreads have come down and yields have come down writ large across BDC space, we still think it's incredibly attractive. I think a lot of bad things were also priced into the figures from a credit standpoint, and so I think given how we feel about credit quality and the outlook, of credit on a go forward basis, with current yield and credit quality, I mean, we just think it's incredibly attractive, and hence, as we mentioned, why we'd continued with some of the stock buybacks, at these levels.
Yeah. So let's talk about those buybacks. We'll get to looking at some of the questions here, Matt. With the discount to the NAV, given the current price, are you guys buying stock back? What is the plan? What have you announced as it
Yeah.
relates to the buybacks?
Yeah, so we previously announced, over the last, I guess, almost 2 years now of being public. So we had two buyback programs in place. One that are called kind of 10b5-1 programs. So they're kind of automatically done on preset parameters at certain discounts. And so each quarter, in our 10Q and 10K, we report what those amounts have been. But we wanted that to be in place from the get-go, from the BDC itself in particular. We also put in place a management team buyback program. So similar construct, but actually from the management company, not from the BDC. So that's been active as well. And then last quarter, we announced an additional $5 million open market buyback program. So to the extent we find a day or a week or what have you where we think things are just at a really attractive level, it gives us another pocket of capital to initiate buybacks. So we thought those were very prudent things to put in place. We think it's obviously good from a shareholder standpoint, but in these type of markets, it's certainly, I think, been very accretive to have those in place.
Sure. So looking here at the questions, make a comment about I think you did earlier, but the mix of private credit loans, versus the liquid part of the book.
Yeah, so as of the end of I guess the last we reported was third quarter of 2025, it was around 10% of the portfolio. And that had kind of been, methodically inching up as we kind of continue to find opportunities there. I said we don't have, any specific target that we, are setting to achieve. We want to, go where we see the best relative value. But I think in the current environment with, where we see spreads on the private credit versus public credit side, I still think there's room for that to go higher. And I think that's been a nice way for us to pretty much maintain pretty level spreads across the portfolio, whereas others you've obviously seen overall spread contraction.
Got it. Another question here, Matt, as you think about the shareholder base within the BDC space and maybe PSBD specifically, there are a lot of investors out there, institutional investors that, participate in the BSL markets and the credit markets broadly. So are they buying your stock? Are they going direct? How do you think about your shareholder base? Um, and in particular, relative to the current NAV discount that exists?
Yeah, it's been interesting for us to see, in the BDC space, kind of the institutional versus retail, differentials over time. I mean, we as an institution have been more heavily institutional investor focused over the long term, and so I think that's been part of it. I'd say the BDC space in general, I feel like has been more kind of retail oriented over time. And so that's one thing we're, working on continuing to do is develop more, relationships on the retail side, to kind of, get the Palmer Square name, more known, as we haven't had a lot of, historical retail products. It's been more institutional, focused in nature. So I think as the market evolves, you've continued to see, new institutional accounts come in, but they also have access, right, to some of the private market funds and even, perpetual non-traded BDCs, over time as well, which, obviously continue to, grow on the retail side of things as well.
Sure.
It's been a healthy mix for us. I'd say we've definitely leaned more institutional in the past, and I think it's one thing we're focused on is trying to do a little bit more, on the retail side of things, just to, kind of develop those type of relationships like we have on the institutional side.
Sure. Maybe I'll take that, Matt, too, as an institutional investor. I mean, to replicate, for us to replicate what you do, I mean, we could certainly replicate that, right? But to have the credit research, to have, $1 to $5 million ticket sizes, right? And to also manage leverage on our side. I mean, there's a lot to manage there for us to replicate that. And then that's obviously a sleeve of the portfolio. It's not the whole portfolio. And so I think in some ways, to the extent that there's massive institutional investors that can access the BSL market and the credit markets broadly, I think they certainly should do that and go do that. But for investors where they're at a certain scale where they can't go replicate the in-house capabilities of that, there is obviously the option to invest in PSBD, and because it is liquid, it does have a very different characteristic than the other BDCs. And that's what drives, I think, Matt, the higher yield actually that sits here. Those are my comments on that question. Another question on the software space. You've got lots of sector. You've got broad diversification across sectors. There is some fear in the private credit market, maybe even the public credit market, that these AI tools are going to, make all these software businesses obsolete. How are the credit markets thinking about that? How are you guys thinking about that for the PSBD, sector exposure specifically?
Yeah, that's a really good question, and it's absolutely right. I think there is a lot, and rightfully so, a lot of focus on the software space at writ large, and the private credit markets. I know there's a lot of portfolio. I mean, some portfolios that are 100% dedicated to software, but others that are severely overweight. Look, I think it's a big sector, and to paint paint everything as just a software company with one brush, is not the right way to look at it. The way we think about it, we break it down into several different subsectors. I think some of which are undoubtedly in what we kind of call the crosshairs of AI. And I think a lot of those, we've been concerned about, even kind of pre-AI fears, just from technological advancements, obsolescence. Software is ever changing. You have to develop or invest a lot as an R&D, and it can be capital intensive. And so we always look at kind of legacy software versus the kind of next gen. How do those fit together? We've been relatively negative on some of the kind of legacy type software over time. So where we do have exposure and what we do like in the sector tends to be on what we kind of view as very mission critical software. So when you think about ERP software, which goes across basically every end market industry,
Yeah.
those are very, very mission critical. you can't really tear those out and still operate your business. So even during
Sure.
COVID, right, with some businesses that, revenue went to zero, they're still paying their monthly or quarterly ERP software bill because
Yeah.
it's lights off if you don't. And those, you see kind of net retention rates on a lot of those businesses that are 105, 110% because they have
Sure.
annual escalators in those contracts. So we really like the ERP businesses. We think those are very well shielded towards AI, and quite frankly, a lot of those will utilize some AI tools to help their
Sure.
customers from an automation standpoint. I think cybersecurity is a growing piece of the software space. It's one that we are pretty constructive on, but I think within that you can kind of paint some of the legacy versus kind
Yeah.
of newer type of cybersecurity products. But that's something we think have a lot of long-term tailwinds, and quite frankly, actually AI introduces a new risk for businesses, right? And so from a cybersecurity standpoint, so I think there's a lot of growth in some of those sectors. So we've got several underwriters and analysts that cover those different sectors, and again, we kind of break it out on a lot of different subsectors. But we think there's certain pockets of that market that are doing really really well. One area where we do not focus on. That I know a lot of private credit BDCs have exposure to is kind of the recurring revenue model.
Sure.
So where
Yes.
the company's not actually generating cash flow, a lot of those loans tend to be kind of 100% pick at the onset, and that's not to say that they're bad businesses. It's just from us, from a cash flow lender mentality, and kind of how we think about software risk. Those businesses have to grow at very very high revenue levels to kind of make those capital structures work. And so from a risk management and portfolio management standpoint, that's just kind of one area of the software market where we've just kind of stayed away.
Yeah. Thank you. So, but maybe one distinction there, Matt, is that, because the BDC market is a lot of private loans, right? If they're lending to software businesses that have obsolescence risk, their ability to trade in and trade out of those private loans is just more difficult than you face, given the fact that a significant majority of your loans are actually liquid, where you might look at a sector, you might look at a business, and you could probably trade out of that business if you needed to, if you thought that the risk was too high. Is that a
Yeah,
fair
no,
characterization?
that is fair. That's right. And that's how we kind of think, kind of back to one of the earlier questions you were asking. We think about that a lot on a relative value basis, on a risk basis. Where do we want to be positioned, and how do we want to be positioned, over the near, intermediate, and long term. And when you're in the private credit, loans, those are obviously long term, views where you're not going to have that liquidity.
Okay. I think we're through most of the questions, Matt. Are there any other questions from anyone? Any final comments, Matt?
I just want to say thank you again to everyone that's been on today. It's been a pleasure to be able to talk all things credit, and certainly want to thank you, Matt. I always love chatting with you. You have such a great outlook, given you look across so many different asset classes. That's always kind of fun to get to talk markets with you. Appreciate it.
Great. It was fun.
Excellent. Matt, thank you both, and thank you to everyone on the line. For more information on Palmer Square Capital BDC, please visit the company's investor relations website at www.palmersquarebdc.com. And if you have questions or would like to get in touch with their investor relations team, you can contact PSBD at prosec.com. And that is it for today. But best of luck, guys, in the new year, and thanks again for joining us.
Thanks,
Thanks.
guys.
Okay.